Most people think investing is only for experts, stock traders, and wealthy individuals. That belief is costing them years of financial growth. The truth is simple. You do not need to pick winning stocks to build wealth. You do not need a finance degree. You do not need perfect timing. What you need is a system. A mutual fund is one of the most powerful wealth-building tools ever created for ordinary people. In this audiobook, you will learn what a mutual fund is, how it works, why millions of investors use it, and how it can help you turn small amounts of money into long-term financial freedom. Let's begin. Chapter 1. Stop fearing investing and start understanding it. Most people are not poor because they lack opportunity. Most people are poor because they lack understanding. That's the key. They fear investing. They avoid investing. They postpone investing. Not because investing is impossible, but because investing feels unfamiliar. And what feels unfamiliar often feels dangerous. That's the key. Think about it. Many people will spend years working for money. Yet they spend almost no time learning how money works. They work hard. They earn income. They pay bills. They repeat the cycle. Year after year. Decade after decade. And they wonder why financial freedom never arrives. That's the key. Knowledge creates confidence. Remember that. Knowledge creates confidence. Again. Knowledge creates confidence. Fear often comes from not knowing. When you understand something, fear begins to disappear. A child fears the dark because they cannot see what is there. Turn on the light. Fear fades. Investing works the same way. When you understand investing, uncertainty decreases. Confidence increases. That's the key. You have a choice. You can continue avoiding investing because it seems complicated. Or you can take the time to understand it. One choice keeps you stuck. The other moves you forward. That's the key. Many people believe investing is only for wealthy individuals. That is simply not true. They imagine stock traders staring at screens all day. They imagine financial experts using complicated language. They imagine investing requires enormous amounts of money. None of those beliefs help them. And many of those beliefs are wrong. That's the key. The wealthiest investors understand a simple truth. You do not need to know everything to begin. You simply need to understand the fundamentals. Step by step. Lesson by lesson. Decision by decision. That's the key. You don't have to do it alone. Remember that. You don't have to do it alone. Again. You don't have to do it alone. This is one reason mutual funds became so popular. Millions of people wanted a way to invest without becoming market experts. They wanted professional guidance. They wanted diversification. They wanted simplicity. Mutual funds help provide that solution. That's the key. Imagine trying to build a house completely alone. You could do it. But it would take tremendous time and expertise. Now imagine working with experienced professionals. The process becomes easier. The outcome often becomes better. Investing can work the same way. That's the key. Many people lose years waiting for the perfect moment. They say, "I'll start when I earn more. I'll start next year. I'll start after I learn everything." The problem is simple. Next year becomes another year. Then another. Then another. Meanwhile, time keeps moving. That's the key. Time is one of the most powerful assets an investor possesses. Not intelligence. Not luck. Not prediction. Time. Because time allows growth. Time allows learning. Time allows compounding. That's the key. Most people underestimate the cost of waiting. Every year spent avoiding investing is a year lost. Every year spent ignoring financial education is a year that cannot be recovered. That's why understanding matters so much. That's the key. It's not about perfection. It's about progress. It's not about knowing everything. It's about learning something. It's not about becoming an expert overnight. It's about becoming better than you were yesterday. That's the key. The purpose of this audiobook is not to turn you into a professional fund manager. The purpose is to help you think differently about investing, to help you replace fear with understanding, confusion with clarity, hesitation with action. That's the key. Understanding comes first. Remember that. Understanding comes first. Again. Understanding comes first. Before investing money, invest attention. Before seeking returns, seek knowledge. Before chasing opportunities, build understanding. Because understanding creates confidence. And confidence creates action. That's the key. The people who build wealth are not always the smartest people in the room. They are often the people willing to learn, willing to listen, willing to improve, willing to take the first step. That's the key. You have a choice. Continue fearing what you do not understand, or begin learning what can change your future. One path leads to hesitation. The other leads to opportunity. One path keeps money working for someone else. The other helps money start working for you. That's the key. Today, you made an important decision. You started learning. You started asking questions. You started building understanding. And that is where every successful investing journey begins. Not with money. Not with markets. Not with predictions. With understanding. That's the key. You have taken the first step. Now it is time to understand exactly what a mutual fund is and why millions of investors trust it to help build their financial future. Chapter 2: Understand what a mutual fund really is. Chapter 2: Understand what a mutual fund really is. Most people hear the words, mutual fund, and immediately assume it is complicated. They imagine financial jargon, complex strategies, endless numbers. But the truth is much simpler. A mutual fund is one of the easiest investment concepts to understand. That's the key. Complexity scares people. Simplicity creates action. That's the key. Let's begin with a simple definition. A mutual fund is a pool of money collected from many investors. That money is then invested by professional fund managers into stocks, bonds, or other investments. That's it. Many investors. One fund. Remember that. Many investors. One fund. Again. Many investors. One fund. Imagine 1,000 people each contribute money into a large basket. Instead of buying investments individually, they combine their resources. Now the basket can own many different investments. That basket is essentially a mutual fund. That's the key. The power comes from pooling resources. One investor may only have a small amount to invest. But thousands of investors together create a powerful investment pool. This allows access to opportunities that might otherwise be difficult to reach. That's the key. You have a choice. Try to build an entire investment portfolio by yourself. Or participate in a professionally managed portfolio. One requires significant time and expertise. The other provides simplicity and structure. That's the key. Many people believe investing means constantly selecting individual stocks. They think they must predict which company will succeed, which stock will rise, which market will outperform. That belief keeps many people from starting. Mutual funds solve that problem. That's the key. Instead of buying one company, a mutual fund may own dozens, sometimes hundreds, sometimes even thousands of investments. The investor does not need to choose every stock. The fund manager does that work. That's the key. Own the basket, not the burden. Remember that. Own the basket, not the burden. Again. Own the basket, not the burden. The average investor often struggles with one major challenge: information overload. Every day there are headlines, predictions, opinions, market forecasts, economic concerns. It becomes overwhelming. Many people quit before they even begin. Mutual funds simplify the process. That's the key. Professional fund managers spend their careers researching investments. They analyze companies, study markets, evaluate risks, monitor opportunities. Their full-time job is managing money. That's the key. You don't have to do it alone. You don't need to become a market expert overnight. You don't need to spend hours every day analyzing financial statements. Mutual funds provide professional management. That is one reason they became so popular around the world. That's the key. Let's talk about ownership. When you invest in a mutual fund, you do not directly own every stock inside the fund. Instead, you own units or shares of the fund itself. Those units represent your portion of the entire portfolio. As the portfolio grows or declines, the value of your investment changes. That's the key. Think of it like owning a slice of a very large pie. You may not own the entire pie, but you participate in the results. When the pie grows, your slice grows. When the pie shrinks, your slice shrinks. Simple. That's the key. Diversification creates strength. Remember that. Diversification creates strength. Again. Diversification creates strength. One of the greatest advantages of mutual funds is diversification. Instead of depending on one investment, your money can be spread across many investments. This helps reduce risk. If one investment performs poorly, others may help offset the impact. That's the key. Most beginners underestimate the value of diversification. They focus only on potential gains. Professional investors focus on both opportunity and protection. Mutual funds help provide both. That's the key. It's not about finding one perfect stock. It's about building a stronger overall portfolio. It's not about predicting every market movement. It's about participating in long-term growth. That's the key. Many people delay investing because they believe they need a large amount of money. Mutual funds challenge that belief. Many investors begin with modest amounts. What matters most is not the size of the starting point. What matters is developing the habit. That's the key. Small amounts invested consistently can grow significantly over time. The wealthy understand this. They focus on process, not perfection. They focus on consistency, not excuses. That's the key. You have a choice. Continue believing investing is complicated. Or recognize that successful investing often begins with simple principles. Many investors. One fund. Professional management. Diversification. Long-term growth. That's the foundation. That's the key. Now that you understand what a mutual fund is, it's time to explore one of its greatest strengths. Because the real power of mutual funds is not simply pooling money. The real power is diversification. And diversification can protect investors from some of the biggest mistakes in investing. Chapter 3. Stop picking stocks and start owning diversification. Chapter 3. Stop picking stocks and start owning diversification. One of the biggest mistakes new investors make is believing they must find the perfect stock. They spend hours searching, hours predicting, hours worrying. Which company will win? Which stock will double? Which investment will make them rich? The truth is simple. Most people are asking the wrong question. That's the key. The goal is not finding one winner. The goal is building a portfolio that can survive and grow over time. That's the key. Many investors lose money because they place too much faith in a single outcome. One company. One stock. One prediction. One bet. When that bet fails, their entire plan falls apart. That's the danger. That's the key. Don't bet everything on one outcome. Remember that. Don't bet everything on one outcome. Again. Don't bet everything on one outcome. Imagine a farmer planting only one crop. If the weather changes, the crop fails. If disease appears, the crop fails. If market prices collapse, the crop fails. Everything depends on one outcome. That is risk. Now imagine a farmer planting multiple crops. One may struggle. Another may succeed. A third may thrive. Risk becomes more manageable. That is diversification. That's the key. Diversification simply means spreading your investments across many opportunities instead of relying on just one. It sounds simple. Because it is. Yet it is one of the most powerful concepts in investing. That's the key. You have a choice. Concentrate everything into one idea. Or spread your risk across many opportunities. One creates vulnerability. The other creates resilience. Successful investors choose resilience. Again and again. That's the key. Think about some of the largest companies in history. Many once appeared unstoppable. Many looked invincible. Many investors believed they could never fail. Yet business history tells a different story. Markets change. Technology changes. Consumer behavior changes. Competition appears. Even great companies can struggle. That's why diversification matters. That's the key. Spread risk. Increase stability. Remember that. Spread risk. Increase stability. Again. Spread risk. Increase stability. A mutual fund makes diversification simple. Instead of owning one stock, a mutual fund may own dozens or even hundreds of investments. If one company performs poorly, the entire portfolio is not destroyed. Other investments continue working. That creates balance. That creates protection. That's the key. Many people misunderstand diversification. They think diversification guarantees profits. It does not. Nothing guarantees profits. Diversification does something more important. It reduces dependence on a single outcome. That's the key. Professional investors understand this deeply. They know predicting the future is difficult. They know mistakes happen. They know uncertainty exists. Instead of trying to be perfect, they build portfolios designed to handle uncertainty. That's the key. You don't need their permission. You do not need permission to avoid risky speculation. You do not need permission to reject gambling behavior. You do not need permission to invest intelligently. Because intelligent investing focuses on probability, not prediction. That's the key. Think about a bridge. Would you trust a bridge supported by only one cable? Probably not. You would feel safer knowing multiple supports hold it together. Diversification works the same way. Multiple investments create multiple supports. That's the key. Protection supports growth. Remember that. Protection supports growth. Again. Protection supports growth. Many new investors become obsessed with maximizing returns. The wealthy often focus on minimizing mistakes. That difference changes everything. Because avoiding major losses is one of the fastest ways to improve long-term results. That's the key. A portfolio that survives difficult periods has the opportunity to recover and grow. A portfolio destroyed by concentration may never recover. That's why diversification remains one of the most important principles in fund management. That's the key. It's not about excitement. It's about discipline. It's not about chasing winners. It's about managing risk. It's not about being lucky. It's about being prepared. That's the key. The beauty of mutual funds is that diversification is built into the structure. The fund manager spreads investments across multiple companies, industries, and sometimes even countries. This reduces exposure to any single failure. That's the key. Many investors spend years trying to predict which stock will become the next big winner. Meanwhile, disciplined investors quietly build diversified portfolios and allow time to work in their favor. One approach depends on prediction. The other depends on process. That's the key. You have a choice. Become obsessed with finding the perfect investment. Or focus on building a stronger investment system. One creates stress. The other creates stability. Millionaires and professional fund managers understand this. Systems outperform guesses. Again and again. That's the key. Diversification may not sound exciting. It may not create dramatic headlines. It may not generate dinner table stories. But it has helped millions of investors build wealth while managing risk. That is what matters. That's the key. A successful investor understands something important. The future is uncertain. No one knows exactly what will happen next. But diversification allows you to participate in opportunities while protecting yourself from unnecessary risk. That balance is powerful. That's the key. Now you understand one of the greatest advantages of mutual funds. They help investors spread risk and build stronger portfolios. But a question remains. Who decides which investments belong inside the fund? Who researches the companies? Who manages the portfolio? Who makes the investment decisions? The answer lies with the professionals behind the fund. Chapter 4. Discover who manages your money. Management is one of the biggest advantages of mutual funds. Again. Professional management is one of the biggest advantages of mutual funds. Think about any profession. If you need surgery, you seek a trained surgeon. If you need legal advice, you seek a trained lawyer. If you need architectural plans, you seek a trained architect. Experience matters. Knowledge matters. Expertise matters. The same principle applies to investing. That's the key. Fund managers spend their careers studying markets. They analyze companies, review financial reports, monitor economic trends, evaluate risks, search for opportunities. This is their full-time responsibility. That's the key. Most investors simply do not have the time to perform this level of research. They have jobs, families, responsibilities, businesses. Mutual funds help bridge that gap. Professional managers perform much of the analysis on behalf of investors. That's the key. Professionals do the heavy lifting. Remember that. Professionals do the heavy lifting. Again. Professionals do the heavy lifting. A fund manager's job is not simply buying investments. A good manager follows a strategy. Every fund has objectives. Some focus on growth. Some focus on income. Some focus on stability. Some focus on a combination of goals. The manager works to align investments with those objectives. That's the key. Imagine a football coach. The coach does not randomly choose players. The coach studies strengths, builds a strategy, creates a game plan, makes adjustments when conditions change. Fund managers operate in a similar way. That's the key. You have a choice. Try to analyze hundreds of investments yourself. Or leverage the expertise of professionals. One requires enormous effort and specialized knowledge. The other provides access to experienced management. That's the key. Of course, professional management does not guarantee success. No manager can predict the future perfectly. Markets are unpredictable. Economic conditions change. Unexpected events occur. Even experienced professionals make mistakes. That's the reality. That's the key. What professional management offers is not certainty. It offers expertise. And expertise improves decision-making. That's the key. Many people expect investing to be about certainty. The wealthy understand investing is about probabilities. No one knows exactly what will happen tomorrow. The goal is making intelligent decisions based on available information. That's the key. Expertise has value. Remember that. Expertise has value. Again. Expertise has value. Fund managers are often supported by teams of analysts. These analysts examine industries, study companies, review earnings reports, monitor trends, gather information. Their research helps support investment decisions. That's the key. Think about the amount of information produced every day in financial markets. Thousands of companies. Thousands of reports. Thousands of economic indicators. It would be impossible for most individuals to analyze everything effectively. Professional teams help solve that challenge. That's the key. You don't need their permission. You do not need permission to use professional expertise. You do not need permission to simplify your investing process. You do not need permission to focus on your strengths while experts focus on theirs. That's the key. Many investors misunderstand fees. They see a management fee and immediately focus on the cost. The wealthy often focus on value. What expertise am I receiving? What research is being performed? What management is being provided? Those are important questions. That's the key. Management creates efficiency. Remember that. Management creates efficiency. Again. Management creates efficiency. A professional manager continuously reviews the portfolio. If conditions change, adjustments may be made. If opportunities appear, action may be taken. If risks increase, decisions may be evaluated. Management is an ongoing process, not a one-time event. That's the key. It's not about perfection. It's about discipline. It's not about prediction. It's about preparation. It's not about guarantees. It's about intelligent management. That's the key. One reason mutual funds became so popular is because they allow ordinary investors to benefit from professional oversight. Investors do not need to become market experts themselves. They gain access to structured investment management. That's the key. The best fund managers think long-term. They focus on strategy. They focus on process. They focus on discipline. Because successful investing is rarely about one decision. It is about many good decisions repeated over time. That's the key. You have a choice. Believe investing requires doing everything alone. Or recognize the value of professional guidance. One creates unnecessary complexity. The other creates efficiency and structure. That's the key. Understanding who manages your money is important. But understanding how that money grows is even more important. Because ultimately, every investor wants to know one thing. How does a mutual fund actually create returns? How does money inside the fund grow over time? The answer lies in understanding the engines that drive investment growth. Chapter 5. Learn how mutual funds make money. Chapter 5. Learn how mutual funds make money. Every investor eventually asks the same question. How does my money actually grow? It's a fair question. You are investing for a reason. You want progress. You want growth. You want financial improvement. That's the key. Understanding how mutual funds make money helps transform confusion into confidence. When you understand the process, you stop guessing. You start thinking like an investor. That's the key. Money grows through a process. Remember that. Money grows through a process. Again. Money grows through a process. Many beginners imagine investing as a single event. They invest money. Then wait. Then hope. But successful investing is not built on hope. It is built on systems. It is built on growth mechanisms that operate over time. That's the key. Mutual funds generally make money in three primary ways: capital appreciation, dividends, interest income. These three forces often work together to create long-term growth. That's the key. Let's begin with capital appreciation. This simply means the investments inside the mutual fund increase in value. If a company grows its profits, expands its business, and becomes more valuable, its stock price may rise. When many investments inside a fund rise in value, the overall fund can grow. That's the key. Growth creates wealth. Remember that. Growth creates wealth. Again. Growth creates wealth. Think about planting a tree. You do not expect immediate results. Growth happens gradually. Month after month. Year after year. Eventually, the difference becomes remarkable. Investing works much the same way. That's the key. Many investors become impatient. They expect instant results. Instant wealth. Instant success. The market does not work that way. Real wealth often grows slowly before it grows significantly. That's the key. The second source of growth comes from dividends. Some companies share a portion of their profits with shareholders. These payments are called dividends. When a mutual fund owns dividend-paying companies, those payments may flow into the fund. That's the key. Money can earn money. Remember that. Money can earn money. Again. Money can earn money. This is where many people begin to understand the true power of investing. Your money is no longer sitting idle. Your money is working. Your money is participating in business growth. Your money is generating income. That's the key. The third source of returns comes from interest income. Many mutual funds own bonds and other fixed income investments. These investments often pay interest. Just as a bank may pay interest on savings, bonds may generate interest payments for investors. That's the key. Now imagine combining all three: growth from rising investments, income from dividends, income from interest. Together they create a powerful engine for long-term wealth building. That's the key. You have a choice. Focus only on earning money from work, or allow your investments to work alongside you. One depends entirely on your effort. The other allows your money to contribute. That's the key. Perhaps the most powerful concept in investing is reinvestment. Instead of spending dividends and interest, many investors reinvest them. Those earnings purchase additional investments. Those investments create additional earnings. Then those earnings create even more earnings. This process is called compounding. That's the key. Let growth build growth. Remember that. Let growth build growth. Again. Let growth build growth. Compounding is one of the greatest wealth-building forces ever discovered. The wealthy understand this deeply. They know that time multiplies disciplined investing. They know patience creates opportunities. They know consistency creates results. That's the key. Many people underestimate the impact of small contributions. A modest investment may not seem impressive today, but over years and decades, growth can become substantial. That is why successful investors think long-term. That's the key. It's not about speed. It's about consistency. It's not about excitement. It's about discipline. It's not about getting rich quickly. It's about getting stronger financially over time. That's the key. Mutual funds provide a structure where growth, dividends, interest, and compounding can work together. This combination helps explain why mutual funds have become such a popular investment tool around the world. That's the key. Of course, growth is never guaranteed. Markets move up. Markets move down. Economic conditions change. Short-term results fluctuate. That is normal. That's the key. The wealthy understand that investing is not about controlling markets. It is about controlling behavior. Staying disciplined. Remaining patient. Following a process. That's the key. You don't need their permission. You do not need permission to think long-term. You do not need permission to ignore short-term noise. You do not need permission to invest consistently while others chase quick profits. Because wealth is usually built through patience, not excitement. That's the key. The most successful investors understand something important. Money grows best when given time. Time allows businesses to expand. Time allows dividends to accumulate. Time allows compounding to work. Time allows wealth to develop. That's the key. Now you understand how mutual funds make money. Through growth. Through dividends. Through interest. Through compounding. But understanding growth is only part of the journey. Because many investors make a dangerous mistake. They become obsessed with quick profits and short-term gains. And that mindset often destroys long-term success. Chapter 6. Stop chasing quick profits and start thinking long-term. Chapter 6. Stop chasing quick profits and start thinking long-term. One of the biggest enemies of successful investing is impatience. People want results now. They want wealth now. They want financial freedom now. And that desire often leads them in the wrong direction. That's the key. The market is filled with distractions. Promises of quick riches. Hot investment tips. Trending stocks. predictions of instant success. Most of these distractions have one thing in common. They appeal to emotion, not discipline. That's the key. The wealthy understand a simple truth. Wealth is usually built slowly. Not instantly. Not overnight. Not in a week. Not in a month. Over years. Over decades. That's the key. Time multiplies discipline. Remember that. Time multiplies discipline. Again. Time multiplies discipline. Think about a farmer. A farmer plants seeds. Then waits. The farmer cannot force the harvest to arrive tomorrow. Growth requires time. Patience is part of the process. Investing works exactly the same way. That's the key. Many investors destroy their progress because they become impatient. They invest. A few weeks pass. Nothing dramatic happens. They become frustrated. They start chasing something faster. Then something faster. Then something faster. Eventually, they stop investing and start gambling. That's the danger. That's the key. You have a choice. Follow a proven long-term strategy. Or constantly chase shortcuts. One path creates stability. The other creates stress. One builds wealth. The other often destroys it. That's the key. The market rewards patience more often than excitement. This lesson is difficult for many people to accept. Because patience feels slow. Excitement feels productive. But feelings are not facts. That's the key. Many of the world's most successful investors built wealth through consistency. Not constant trading. Not endless speculation. Not emotional decisions. Consistency. That's the key. Stay invested. Remember that. Stay invested. Again. Stay invested. When markets rise, many people become greedy. When markets fall, many people become fearful. These emotional reactions lead to poor decisions. People buy when excitement is highest. People sell when fear is strongest. And then they wonder why results disappoint them. That's the key. Professional investors understand that emotions are expensive. Fear can cost money. Greed can cost money. Impatience can cost money. Discipline saves money. That's the key. It's not about excitement. It's about discipline. It's not about prediction. It's about consistency. It's not about chasing opportunities. It's about following a plan. That's the key. Consider two investors. The first constantly jumps between investments. Always searching for the next big thing. Always reacting to headlines. Always changing direction. The second follows a disciplined strategy. Invests consistently. Stays focused. Remains patient. 10 years later, who is more likely to succeed? Usually the disciplined investor. That's the key. Many people overestimate what they can achieve in 1 year. At the same time, they underestimate what they can achieve in 10 years. This is why long-term thinking is so powerful. Small actions repeated consistently become extraordinary results. That's the key. Consistency wins. Remember that. Consistency wins. Again. Consistency wins. A mutual fund is designed for this type of thinking. It encourages diversification. It encourages patience. It encourages long-term participation. It encourages discipline. These are the habits that build wealth. That's the key. The wealthy often focus on decades. The average person focuses on days. That difference changes everything. Because wealth is rarely created by reacting to short-term market movements. Wealth is created by staying committed to long-term goals. That's the key. You don't need their permission. You do not need permission to ignore market noise. You do not need permission to stay focused when others panic. You do not need permission to think differently. Because long-term thinking often separates successful investors from unsuccessful ones. That's the key. Markets will rise. Markets will fall. Economic conditions will change. News headlines will come and go. None of these things change the importance of patience. None of these things change the value of discipline. None of these things change the power of consistency. That's the key. Successful investors understand something most people forget. The market transfers wealth from the impatient to the patient. Read that again. The market transfers wealth from the impatient to the patient. That's the key. Every day you face a decision. Will you focus on today's noise? Or will you focus on tomorrow's opportunities? Will you react emotionally? Or will you act strategically? Will you chase excitement? Or will you build wealth? You have a choice. That's the key. Long-term investing is not glamorous. It is not exciting every day. It does not create instant gratification. But it creates something far more valuable. Results. That's the key. Now you understand why patience matters. You understand why discipline matters. You understand why long-term thinking matters. But every investment carries risk. And successful investors do not ignore risk. They understand it. They prepare for it. They manage it intelligently. Chapter 7. Understand the risks before you invest. Chapter 7. Understand the risks before you invest. Most people want returns. Very few want to understand risk. That's the problem. Because you cannot build wealth without understanding what can destroy it. That's the key. Risk is not the enemy of investing. Ignoring risk is. Remember that. Risk is not the enemy. Ignoring risk is. Again. Risk is not the enemy. Ignoring risk is. Many beginners enter investing with one expectation. They expect money to go up. Smoothly. Consistently. Without interruption. But real markets do not work that way. Markets move up. Markets move down. Markets move sideways. That is normal. That is reality. That's the key. You have a choice. Expect perfection. Or understand reality. One leads to shock. The other leads to stability. That's the key. The first type of risk is market risk. This means the entire market can rise or fall due to economic conditions, global events, or investor sentiment. Even strong investments are affected. Even good companies feel the impact. That's the key. No investment exists in isolation. Remember that. No investment exists in isolation. Again. No investment exists in isolation. The second type of risk is volatility. Volatility means prices move up and down frequently. Sometimes sharply. Sometimes unexpectedly. This scares many beginners. They see a drop and assume something is wrong. But volatility is normal behavior in investing. That's the key. Volatility is not failure. Volatility is movement. That's the key. The third type of risk is emotional risk. This is the most dangerous one. Because it does not come from the market. It comes from you. Fear. Panic. Greed. Impatience. These emotions often lead to poor decisions. Selling too early. Buying too late. Reacting instead of thinking. That's the key. Most investors lose money not because of markets, but because of behavior. Remember that. Behavior drives results. Again. Behavior drives results. Professional investors do not try to eliminate risk. They manage it. That is a very important difference. That's the key. You don't need their permission. You do not need permission to accept that markets are uncertain. You do not need permission to prepare instead of panic. You do not need permission to invest with awareness instead of fear. That's the key. One of the most powerful tools for managing risk is diversification. You already learned this. Spreading investments across many assets reduces dependence on one outcome. If one investment struggles, others may help balance the impact. That creates stability over time. That's the key. Prepare, don't panic. Remember that. Prepare, don't panic. Again. Prepare, don't panic. Another important concept is time horizon. Risk feels higher in the short term. But over long periods, markets tend to smooth out fluctuations. Time reduces emotional pressure. Time increases clarity. That's the key. Short-term thinking amplifies risk. Long-term thinking reduces it. That's the key. Many investors make a simple mistake. They invest money they cannot afford to leave untouched. Then when prices drop temporarily, they panic. They exit at the worst possible time and lock in losses. That is not a market problem. That is a planning problem. That's the key. Good investing starts before you invest, not after. Planning matters. Patience matters. Discipline matters. That's the key. Risk also includes opportunity risk. If you avoid investing completely out of fear, your money may lose value over time due to inflation. This is also a risk. Staying still can be risky. That's the key. Risk exists in both action and inaction. Remember that. Risk exists in both action and inaction. Again. Risk exists in both action and inaction. The goal is not to avoid all risk. That is impossible. The goal is to understand risk. Manage risk. Balance risk. That's the key. Think of risk like driving a car. You cannot remove risk from driving, but you can reduce risk. You wear a seatbelt. You follow rules. You stay alert. You don't drive recklessly. Investing works the same way. That's the key. Many investors chase high returns without understanding risk. That is like speeding without brakes. It may feel exciting, but it is not sustainable. That's the key. Safe investing is not about avoiding movement. It is about controlling decisions. Control your behavior. Control your reactions. Control your discipline. That's the key. You have a choice. React emotionally to market changes, or respond logically with preparation. One creates instability. The other creates confidence. That's the key. Mutual funds help manage risk through diversification and professional oversight. But no system removes risk completely. That is why your mindset matters. Understanding risk helps you stay calm during uncertainty. And calm investors make better decisions. That's the key. Now you understand risk. Not as something to fear, but as something to manage. And successful investing is not about avoiding challenges. It is about navigating them wisely. Next, you will discover the different types of mutual funds. Because not all funds are the same. And choosing the right type of fund depends on your goals. Chapter 8. Discover the different types of mutual funds. Chapter 8. Discover the different types of mutual funds. Not all mutual funds are the same. That's where many beginners get confused. They assume one fund works like all funds. But that is not true. Different funds serve different purposes, different goals, different levels of risk. That's the key. If you don't understand the types of mutual funds, you cannot choose wisely. And if you cannot choose wisely, you cannot invest confidently. That's the key. You have a choice. Learn the system. Or guess your way through it. One leads to control. The other leads to confusion. That's the key. Let's simplify it. There are a few main types of mutual funds. Each one has a specific purpose. Each one behaves differently. Each one fits different investor goals. That's the key. The first type is equity mutual funds. These funds invest mainly in stocks, companies, businesses, growth-oriented investments. They aim for higher returns over the long term. But they also come with higher volatility. That's the key. Higher growth. Higher risk. Remember that. Higher growth. Higher risk. Again. Higher growth. Higher risk. Equity funds are for investors who can stay patient. Investors who can handle ups and downs. Investors who think long term. That's the key. The second type is debt mutual funds. These funds invest in fixed income instruments like bonds, government securities, corporate debt. They are generally more stable than equity funds. But they also offer lower returns. That's the key. Lower risk. Lower return. Remember that. Lower risk. Lower return. Again. Lower risk. Lower return. Debt funds are often used for capital protection and steady income. They are not designed for fast growth. They are designed for stability. That's the key. The third type is hybrid funds. These combine both equity and debt. A balance between growth and stability. They try to reduce risk while still providing growth opportunities. That's the key. Balance creates flexibility. Remember that. Balance creates flexibility. Again. Balance creates flexibility. Hybrid funds are useful for investors who want moderate risk exposure. Not too aggressive. Not too conservative. Somewhere in between. That's the key. The fourth type is index funds. These funds do not try to beat the market. They follow the market. They replicate a market index like a benchmark. That means instead of picking stocks, they mirror the market performance. That's the key. Match the market, don't fight it. Remember that. Match the market, don't fight it. Again. Match the market, don't fight it. Index funds are popular because they are simple, low cost, broadly diversified, and transparent. That's the key. The fifth type is sector funds. These invest in specific industries: technology, healthcare, energy, finance. They focus deeply on one area. That means higher potential growth, but also higher risk. Because if that sector struggles, the fund struggles. That's the key. Focus increases both opportunity and risk. Remember that. Focus increases both opportunity and risk. Again. Focus increases both opportunity and risk. Now step back and see the pattern. Every fund type is a trade-off. Risk versus return. Growth versus stability. Focus versus diversification. That's the key. You don't need their permission. You do not need permission to understand your options. You do not need permission to match investments with your goals. You do not need permission to choose wisely instead of randomly. That's the key. The biggest mistake beginners make is not understanding purpose. They invest without direction, without clarity, without strategy. They choose funds based on trends, or advice, or emotion. That leads to inconsistent results. That's the key. Different goals require different tools. Remember that. Different goals require different tools. Again. Different goals require different tools. If your goal is long-term wealth, equity funds may play a role. If your goal is stability, debt funds may play a role. If your goal is balance, hybrid funds may fit. If your goal is simplicity, index funds may be ideal. That's the key. Successful investors do not chase everything. They choose what fits their plan. They align investments with objectives. They stay consistent. That's the key. Mutual funds are not about guessing. They are about matching. Matching risk to comfort. Matching strategy to goals. Matching time horizon to expectations. That's the key. Many people think investing is complicated. But most complexity disappears when clarity appears. Once you understand categories, decisions become easier. Once decisions become easier, action becomes possible. That's the key. Clarity creates confidence. Remember that. Clarity creates confidence. Again. Clarity creates confidence. Now you understand the different types of mutual funds. But knowing types is not enough. Because understanding investing is only powerful when you know how to actually invest like a professional. How to behave. How to stay disciplined. How to avoid emotional mistakes. That is what separates beginners from serious investors. Chapter 10. Make mutual funds a tool for financial freedom. At this point, you understand how mutual funds work. You understand structure. You understand risk. You understand discipline. You understand long-term thinking. But there is one final truth most people miss. Investing is not the goal. Money is not the goal. Returns are not the goal. Freedom is the goal. That's the key. You have a choice. Keep thinking only about money. Or start thinking about freedom. One keeps you working endlessly. The other gives you control over your time. That's the key. Most people spend their lives chasing income. Salary after salary. Paycheck after paycheck. Expense after expense. And they never stop to ask a deeper question. Why am I doing this? That's the key. Mutual funds are not just investment tools. They are freedom tools. They help transform income into assets. Assets into growth. Growth into options. And options into freedom. That's the key. Remember this clearly. Money is a tool, not a destination. Money should work for you, not against you. Again. Money should work for you, not against you. That's the key. The purpose of mutual funds is simple: to help ordinary investors participate in long-term wealth building, without needing to predict markets, without needing to pick individual winners, without needing to become financial experts. That's the key. You don't need their permission. You do not need permission to start building your future. You do not need permission to think long-term. You do not need permission to act consistently. That's the key. Financial freedom is not created in one moment. It is created in thousands of small decisions. Investing regularly. Staying disciplined. Avoiding emotional mistakes. Trusting the process. That's the key. Small actions become big outcomes. Remember that. Small actions become big outcomes. Again. Small actions become big outcomes. Think about this clearly. A small investment today may seem insignificant. But over time, with consistency and compounding, it can grow into something meaningful. Something powerful. Something life-changing. That's the key. The wealthy are not always the ones who start with the most money. They are often the ones who stay consistent the longest. They understand time is an advantage, not an obstacle. That's the key. Time in the market builds wealth. Remember that. Time in the market builds wealth. Again. Time in the market builds wealth. Mutual funds work best when you stop trying to control every outcome and start focusing on what you can control. Your behavior. Your discipline. Your consistency. That's the key. Markets will rise and fall. That is not in your control. Economies will change. That is not in your control. News will create fear and excitement. That is not in your control. But your actions are always in your control. That's the key. You have a choice. React emotionally, or respond strategically. One creates stress. The other creates progress. That's the key. Financial freedom is not a secret. It is a system. A system built on simple principles. Invest consistently. Stay diversified. Think long-term. Avoid emotional decisions. Trust compounding. That's the key. Mutual funds are one of the simplest ways to follow that system. They bring structure to investing. They bring discipline to decision-making. They bring clarity to long-term planning. That's the key. But only if you use them correctly. Because tools alone do not create results. Behavior does. That's the key. Start where you are. Not where you wish you were. Start small if needed. Start simple if needed. But start with intention. That's the key. Every investor begins as a beginner. Every expert was once uncertain. Every portfolio starts with the first step. That's the key. And now you understand that step. Mutual funds are not complicated systems for experts. They are simple systems for disciplined investors. For people willing to think long-term. For people willing to stay consistent. For people willing to learn and apply. That's the key. Your journey does not end with understanding. It begins with action. Open the account. Start the habit. Stay consistent. Think long-term. That's the key. Because financial freedom is not given. It is built. One decision at a time. One investment at a time. One disciplined action at a time. That's the key. And if you stay consistent long enough, something powerful happens. Money stops being a source of stress and starts becoming a source of freedom. That is the real purpose of mutual funds. That is the real goal of investing. That is the real meaning of wealth. Freedom. The difference between wealth and struggle is rarely income. It is behavior. It is discipline. It is what happens after money enters your hands. Every chapter of this audiobook has pointed to the same truth. Stop wasting money. Start building wealth. Give every dollar a job. Stop buying things you don't need. Stop financing a lifestyle you cannot sustain. Stop seeking approval through spending. Instead, build ownership. Build assets. Build discipline. Build freedom. Remember this. Every dollar you spend is making a decision. Every dollar you invest is making a decision. Every habit you repeat is building your future. You have a choice. Continue consuming and stay where you are. Or start building and become who you are capable of becoming. Starting today, track your spending. Invest consistently. Think long term. And make every dollar work harder than you do.